McDonald's just dropped earnings, and the headline isn't just EPS, it's traffic. Global comparable sales were up 5.7%, and in the US, comps jumped 6.8% with positive guest counts. Those comp numbers matter for one key reason: traffic is growing. In the US, growth wasn't just pricing. Guest counts were positive, meaning more customers are walking through the doors. That's a strong signal in today's consumer environment. Adjusted earnings per share came in at $3.12, up 7% year-over-year in constant currency. System-wide sales reached nearly $140 billion for the full year. Overall, this was a strong quarter. But the real question is, what's driving this growth? The core driver was value. McDonald's leaned heavily into its McValue platform and relaunched extra value meals in the US. They introduced nationally price-pointed offers like $5 breakfast meals and $8 chicken bundles. Management stated they gained share among low-income consumers and achieved the highest quarterly guest count gap versus competitors in recent history. That's a meaningful competitive signal. In a pressured consumer environment, value leadership matters, and McDonald's is clearly leaning into it. But value alone doesn't explain the full story. This is where things get more interesting. McDonald's now has nearly 210 million 90-day active loyalty users across 70 markets. And here's the key statistic. Before joining the loyalty program, the average customer visited about 10.5 times per year. After joining, that number increases to 26 visits per year. That's more than double the frequency. During the Monopoly campaign alone, customers played nearly 500 million digital games, making it one of the largest digital engagement events in company history. This isn't just a fast food company, it's a scaled consumer data platform with massive engagement. Over time, that kind of digital ecosystem can improve marketing efficiency, customer retention, and long-term margins. Now let's talk about profitability. Adjusted operating margin for the full year was 46.9%, which is extremely strong for the restaurant industry. Total restaurant margin dollars exceeded $15 billion. Free cash flow conversion was about 84%. This tells you the business generates real cash and operates with high efficiency. Even while investing in technology and expansion, they are maintaining strong financial discipline. On the growth side, McDonald's opened 2,275 restaurants in 2025 and plans to accelerate to around 2,600 openings in 2026. They remain on track to reach 50,000 total restaurants globally by 2027. China alone is expected to add around 1,000 new locations. That's aggressive unit growth for a company of this scale. New restaurant expansion is expected to contribute roughly 2.5% to system-wide sales growth next year. Looking ahead, management expects operating margins in the mid to high 40% range. Capital expenditures are projected between $3.7 and $3.9 billion, primarily for new development. Interest expense is expected to rise 4% to 6%, while foreign currency could provide an EPS tailwind of 20 cents to 30 cents. Overall, guidance points to steady momentum, not explosive growth, but consistent execution. Here's how I see it. The bullish case: strong traffic growth, value strategy working, loyalty scaling, and continued global expansion. The bearish case: consumer pressure remains, China faces macro challenges, weather impacts traffic, and interest costs are rising. The key question going forward is simple. Can McDonald's continue driving traffic while maintaining these high margins? That's what I'll be watching next quarter. Personally, I like McDonald's for a few reasons. First, the margins. An operating margin near 47% is exceptional in the restaurant industry. That reflects pricing power, operational efficiency, and scale advantages. Second, the real estate model. McDonald's doesn't just sell food, it controls a significant amount of prime commercial real estate globally. That creates stable rental income, strengthens franchise relationships, and adds resilience to the business model. This combination, strong margins, real estate control, global brand power, and digital scale, makes McDonald's one of the highest quality companies in the restaurant sector. That said, valuation always matters. For long-term investors, this is the type of high-quality business that can compound steadily, if you buy it at the right valuation. Personally, I would look at an entry closer to the $290 range, depending on market conditions and how growth trends develop. Always do your own research. Thanks for watching, and I'll see you in the next one.